Campbell Soup Company, NYSE, CPB, stock rose 0.89%, as on September 2, 7:31 p.m. Coordinated Universal Time -4. Source: Google Finance, after the company posted better than expected results for the fourth quarter of FY21. However, the company's shares pullback in recent weeks is due to the mounting fear of inflation. Rising costs are expected to cut into profitability on top of an expected decline in year-over-year sales. For meals and beverages, the fourth quarter organic net sales declined by 9% and end market performance of -2% reflects cycling the partial inventory recovery and elevated consumption levels in the prior year quarter. Compared to the fourth quarter of fiscal 2020, the company has continued to grow share in Swanson broth, condensed soup, Prego, ready-to-serve soup and Pacific Foods. On U.S. soup, the company has delivered another quarter of record share growth of nearly 2 points, with gains in all segments. This included gains from Swanson broth, condensed soup, Well Yes, and Slow Kettle Drive, and by the continued recovery in the total points of distribution or TPDs. CPB in the fourth quarter of FY21 has reported the adjusted earnings per share of 55 cents, beating the analyst's estimate for the adjusted earnings per share by 8 cents. The company had reported the adjusted revenue of $1.87 billion in the fourth quarter of FY21, beating the analyst's estimates for revenue by 300 basis points. Additionally, fiscal 2021 cash flow from operations decreased from $1.4 billion in the prior year to $1 billion primarily due to changes in working capital, mainly from a significant increase in accounts payable in the prior year and lower accrued liabilities in the current year. The year-to-date cash for investing activities was reflective of the cash outlay for capital expenditure of $275 million, which was slightly lower than the prior year driven by discontinued operations and the net proceeds from the sale of Plum. The year-to-date cash outflows for financing activities were $1.7 billion, reflecting cash outlays due to dividends paid of $439 million. In addition, the company has reduced the debt by $1.2 billion. The company has ended the year with cash and cash equivalents of $69 million. Looking forward, the company is anticipating business to remain steady in the coming year. The company's guidance is for flat to slightly lower revenue in fiscal 2022, which is in line with the consensus estimate. The guidance for earnings is $2.75 to $2.85 versus the $2.85 consensus. Meanwhile, the company is planning to increase prices of some products, as it deals with higher ingredient and freight costs that are likely to plague packaged foods makers through the year.